Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Christy Akulian, Director on BlackRock's iShares Investment Strategy team. We are talking about the market outlook and investing strategies for 2023. BlackRock, as we know, is the world's largest asset manager. They have about $8 trillion in AUM currently, and the firm offers about 400 ETFs across all asset classes listed in the US. Christy, welcome back. Great to have you on the show.
Thanks so much for having me.
So this year has been very challenging for investors, and the biggest question for them now is whether the Fed will be able to tame inflation without sending the US economy into a recession. And investors are hoping that if the central bank succeeds in engineering a softish landing, then we could see a gradual recovery in the stock market and bond market next year. So last week, stocks had rallied when the Fed Chair Powell signaled that the central bank may start slowing rate hikes. But then we got subsequent very strong reports on the labor market and services sectors as well. And they again raised concerns that the Fed pivot may not come soon. So we are getting these conflicting signals on the health of the economy, and that is keeping stocks very, very volatile. And BlackRock recently released its 2023 market outlook. So let's start with that. What can investors expect from 2023? Do you see more downside risk for stocks and bonds in the new year?
Yeah, no, I think it's a great place to start and to jump in. I think, the bad news from an investment perspective is that a lot of that volatility that you mentioned at the top, right, and what we've seen investors sort of prematurely forecasting a Fed pause or a pivot, we expect a lot of that volatility to carry forward into 2023. So one of our big takeaways, I think, or one of the theses that we've been talking about is really that we're not just in a new business cycle, we're really in a new regime. So if you look back over the last 15 years or so, what we've seen is that this really accommodative central bank and a monetary policy, that's had a very big job in shaping asset allocation. So that's caused investors to add a lot of risk, sort of in search of yield. That very prolonged period that we saw of those low and those stable rates, it made this big shift kind of away from fixed income and into high growth equities in particular. So, I think what we see next year and also going forward beyond that is that kind of this regime of those lower for longer rates that we've seen over the last 15 years is instead going to transition to a regime of sort of higher from here. So we think that has really profound implications in terms of portfolio construction. So specifically what that means, kind of breaking it down by asset classes a little bit. First, I think I would say that it's hard right now to make a prediction about all of 2023. So even though we just published our iShares, 2023 year ahead investment guide, it's a little bit of a misnomer, if you will, because we're really thinking about no longer positioning for an entire year. We're trying to be a lot more nimble based upon changes that we expect to play out throughout the course of 2023. So we're potentially looking at two very different halves, if you will. So we're kind of thinking of H1 and H2 differently. Although I've stopped short of saying, a tale of two halves. I think Dickens would probably be rolling over in his grave if he knew how much we have been abusing that subject line. So I think that what we can expect to see is for growth to slow. We are calling for a recession in 2023, but unlike recessions that we've seen in the past, especially in the past 15, 20 years, we don't think that the Fed is necessarily going to come to the rescue. So again, we see continued volatility, and that's volatility both in economic growth, in inflation, and also in asset prices. So our our expectation is for us to see positive total returns in fixed income. We think that there's really attractive carry right there in the fixed income market, and I'm sure we'll get into that a little bit later. And we see most of the Fed rate hikes that we expect already priced in. Our outlook is a little bit less positive for equities. We're actually tactically underweight equities at this moment, at least for the first half of the year, until we see some of those valuations fall to reflect a little bit more of that continued volatility and that higher for longer interest rate regime that we expect going forward.
So, as you mentioned, we are transitioning into a new regime now, and there's a lot of uncertainty. And investors have been wondering whether it is time to buy the dips now because stocks have gone down so much. And as you mentioned, that you are still a bit defensive on equities. Are there any areas of the stock market that you like for tactical allocation as of now?
Yeah, definitely. And I think, it's amazing how quickly the buy the dip question comes up in client conversations that we're having. The first question may be, has inflation peaked? And the second question is maybe, are we in a recession or are we headed there? And then immediately thereafter, clients want to pivot and investors are already thinking about buying the dip. I think that that's a reflex that we learned over 2020 and 2021 that we're going to need to pull back on a little bit. So, I think the short answer is that we don't necessarily see the current environment, and again, probably carrying forward through the first half of 2023 as well, as a great time to buy the dip as being a strategy that really had worked in the past, so much so that it's sort of become an acronym in and of itself. So I think that in the past, we've seen asset prices were really quick to sort of mean revert and then sort of continue that upward trend that we saw. We don't expect that to be the case this year. So, stock prices, if we think about it, are at a very high level. They're a function of earnings, they're a function of interest rates, and also just risk sentiment. So equity valuations right now have sort of reverted back to their pre-pandemic average, but we don't necessarily think that that's cheap, especially as we think that we're headed into this slowing growth environment and potentially a recession as well. So we're not necessarily saying that you should be buying on every pullback. So we're not necessarily optimistic about equities kind of writ large, but more specifically, I think that there's opportunities within certain pockets of equities. So we don't actually favor growth equities from here. I think higher interest rates and higher real rates in particular are going to be quite a headwind for growth equities. And what we see and what we found in our research is that those higher real rates in particular favor value. So we favor value over growth tactically over the next year. Another reason for that, too, if you just kind of step back, is that growth equities tend to be much more closely correlated to retail sales. So because we see some further pain coming from the consumer in this particular recessionary outlook, we don't necessarily want to be allocated to growth. But value, on the other hand, those value style equities, they tend to provide exposure to kind of the real economy. So, I think that for this particular outlook, and again, really focusing on the first half of next year, we see opportunity in something like IWD, which is the iShares Russell 1000 Value ETF, or looking at it specifically from a factor lens, the Value, VLUE ticker as well. And then I think kind of moving further along that risk spectrum for those who are looking to add risk into being a little bit more strategic here, we actually see some opportunities in small caps as well. Small caps have much more favorable valuations right now than large caps. So again, for that investor who's really thinking about adding risk and thinking about this for the longer term, we like something like IJR, which is the iShares S&P 500 Small Cap ETF. As being a way to, again, realizing that you're taking on a little bit more risk, but getting into the equity market where we actually do see some favorable valuations relative to the rest of the market, for sure.
So it's been a very challenging year for growth stocks, as you mentioned, because these stocks have benefited from record low interest rates for the past so many years. And now there are other concerns also. So I was looking at the iShares S&P 500 growth ETF. It is down almost 27% year to date, whereas your value ETF, the S&P 500 value ETF, IBE, that is down just about 4%. So very interesting difference in performance. And I agree with you on small caps. The valuations look very compelling, very attractively priced as of now. So those value and small caps for 2023 for tactical allocation makes a lot of sense. Now let's talk about inflation. There have been some signs, some recent inflation reports were cooler than expected. So it seems that inflation is clearly showing signs of moderation, but it may stay well above central bank's 2% target next year, or maybe beyond that. So investors will probably have to learn to live with inflation. And that is another theme in your investing guide. So tell us about that theme, and then we can also talk about ETFs that investors could look at.
Yeah, absolutely. And I think that it's a really important point that you made, and that we've been talking about too, is just, I think that there was a huge amount of fixation over the last year about peak inflation, right? I think that there was a tendency or an urge to sort of call the month exactly where we would notice peak inflation. And I think that the implicit assumption behind that fixation was that inflation would then necessarily decline at sort of a steady rate from there. We don't expect that to be the case, right? So our view here, and one of our three themes, is living with inflation, as you noted, because we do think that it probably has peaked, and that there are some natural impulses to it declining from here. It doesn't mean that it's just going to fade into the background, right? We think that where inflation is going to settle in the medium term even is going to be higher than where it was pre-pandemic. And it's also going to be higher than that Fed 2% target. So, things that we're thinking about in terms of how to live with that are being much more deliberate about adding inflation protection into a portfolio. So, I think that even though some of the pandemic scarring specifically that was causing inflation is going to, that part will in fact start to fade away. And we've seen some of that already. I think that we're seeing supply chains become a little bit less entangled. We're seeing the cost of shipping that's fallen pretty dramatically from even a year ago. But we do think that there's three really structural trends that are going to keep inflation higher for longer. So one is that we think that an aging population is really taking folks out of the workplace and out of the workforce. So we do think that that's going to keep pressure on the labor market, which we've seen consistently over the course of the last year, and even most recently in the latest labor data, is that average hourly earnings have been rising faster than market expectations. So, I think that that's going to be a source of inflation for a longer period than most people were probably hoping for at the start of this year. The second big trend, and one that we've talked about on here before, and that really came into the forefront this year, is really just the geopolitical concerns and tensions. Those are rewiring a lot of supply chains in and of themselves. So whereas, I think in January or this time last year, we were talking about COVID-related supply chain issues, I think now we're talking about it from a geopolitical perspective. So a lot of that friend-shoring and onshoring is necessarily going to be inflationary. We're going to see costs rise as companies are not just thinking about the lowest cost alternative, they're thinking about other considerations as well. And then the third structural trend that I know we've been talking about for many years, and we will continue to be talking about, I'm sure, for decades into the future, is really the net zero transition. So while we do think that that is going to be inflationary in the near term, it's going to be necessary in the long term, right? So I think the combination of those three things really keeps our inflation expectations elevated, not just for this year and next year, but for the medium term, for several years beyond that as well. I think that it's also sort of telling that Chair Powell and the Fed are starting to see the world a little bit like that as well. Most recently sort of carving out and sort of breaking down the different components of inflation. I know we've talked a lot about shelter inflation that makes up almost 40% of core CPI, but also tends to be the stickiest. So we've seen huge rises in shelter inflation this year. That's going to take longer to subside as well. So again, our expectation is that yes, inflation has peaked, but no, it is not just going to decline steadily from here and go back to 2% and all as well. So the way that we're thinking about that in portfolio construction and the conversations that we're having with investors, we see a lot of opportunity in TIPS and treasury inflation protected securities. And then within the equity space too, if we're thinking about sort of a multi-asset way to position a portfolio for inflation, we really like infrastructure equities as well. Those tend to perform fairly well in inflationary environments and can be sort of a thematic play that we see over the medium term to think about inflation proofing a portfolio.
Yeah, those are some very interesting ideas. And I like infrastructure equities because they will also benefit from the bipartisan infrastructure law. And we know that recent midterms have resulted in a split Congress. And this is spending on infrastructure is one of the very few issues that the two parties agree on. So infrastructure equities and ETFs are worth a look. And I like the food inflation theme as well, because we know that the war in Ukraine, that is one of the main reasons for keeping food prices high. But even before the war started, climate change had resulted in higher food prices. And we have now seen persistent droughts in some key growing areas. So food inflation may also stay at elevated levels. And the two ETFs that you highlighted in the investing guide are the iShares US Infrastructure ETF, the ticker symbol is IFRA, and the iShares MSCI Global Agriculture Producers ETF, the ticker symbol is VEGI, easy to remember. For the TIP ETF, I noticed that you recommended the iShares TIPS Bond ETF. The ticker symbol is TIP this time, whereas in your mid-year investing guide, you had recommended the shorter-term TIP ETF, STIP, which focuses on 0 to 5 year TIPS bonds ETFs. So do you think investors should take higher duration risk now? Because I was looking at the performance of these two TIP ETFs, and because the shorter term TIP ETFs has a much lower duration risk. So this is down only about 2.5% year to date, whereas the longer duration TIPS ETF is down about 10.2%. So it protects against inflation, but it had duration risk, so it suffered due to rising rates. So do you think we could see this moderation in rate hikes now? So investors should increase duration in their TIPS portfolios?
Yeah, it's a great point. And you call out a shift in our outlook, and our recommendation there was we were much more focused and we had a lot more conversations around STIP for this year, precisely because we did not want to take on that duration risk at that point. Where we are and we see headline inflation right now, and where we see sort of overly optimistic investor expectations for inflation in the future, combined with the fact that we see interest rate, most of the interest rate hikes behind us, we do feel more comfortable stepping out into the full TIP suite and not just focused on the short-term STIP suite of inflation-protected bonds. I don't think that it's as much an explicit call that we're calling for a longer duration, but for investors who do want to think about recession and potentially adding duration to a portfolio, we much prefer taking that in the form of inflation-protected bonds than in nominals. So TIP over nominal treasuries for sure. And at this point, even based upon sort of investor expectations for near-term and medium-term inflation, TIP over STIP as well.
That makes a lot of sense. So staying on fixed income investing theme for a bit, this year was a record bad year for bonds, mainly because of the rate hikes. And we have seen that some investors have started dumping back into bonds now. And probably they believe that 2023 would be a better year for bonds. And also because of these rate hikes, the payouts have gone up a lot. And those payouts would slightly, help cushion from the damage that is going to be caused by the rising rates. So in your investing guide, you say that it is time to rethink the role of bonds in a portfolio. Tell us about that.
Yeah, absolutely. So I think this is one of the rare bright spots, if you will, in our outlook for 2023 is that we see tremendous opportunity within fixed income. So yes, this 2022 was a very difficult year for stocks, for bonds, for the 60/40 portfolio. But because we see most of those rate hikes behind us and we have sort of a clear through line in terms of, market expectations for terminal rates and where we think that the Fed is going to need to go to combat inflation, we see lots of opportunity just in valuations and in the yields that are on offer within fixed income. And you don't necessarily need to take on a lot of risk to get that. So, I think that in terms of rethinking the role of bonds, we kind of have a tagline internally that we've been using that bonds are back, right? And I think that has a lot of implications for portfolio construction. So one of our big themes for this year and for looking forward to 2023 is really the idea of letting bonds do a lot of the heavy lifting within a portfolio. So if you can get nearly 6% yield in a short-dated investment-grade credit ETF such as IGSB, we really like that opportunity looking forward. So a lot of the investors that we speak to, they may have a specific yield requirement that they're looking for each year. If you're thinking about investors who are, planning for retirement, for example, there is this great graph that we have on our mid-year implementation guide that you can find on iShares.com. I know a podcast maybe not exactly the best medium for a graph, but I'll do my best to describe it for you. But if you're thinking about, targeting a 6.5% yield as an example, in 2022 and looking forward to 2023, you could get that by holding a 65% fixed income portfolio and just 35% equities. If we were thinking about 2015, so, rewinding a little bit, you would have needed to hold 80% equities and just 20% fixed income to get you to that 6.5% yield. So, again, this idea of bonds have more work to do within a portfolio. They can do a lot of that heavy lifting, and they mean sort of rethinking that 60/40 portfolio. 60/40 may not be static anymore, is I guess the way to think about portfolio construction going forward. So, we see lots of opportunities in fixed income. Just to go back, I think that our highest conviction trades right now and where we see the best opportunity is in short-dated fixed income. So if, for even within Treasury bond complex, if you looked at something like SHY, which is our iShares 1 to 3 year Treasury bond ETF, we see really attractive yields right there. If you're willing to take on a little bit of credit risk, IGSB, which I mentioned earlier, is one of the most frequently asked about tickers in all of our client conversations right now. That's, again, just the 1 to 5 year part of the curve, so not taking on a lot of duration risk there. I think that, even in the face of a recession that we do think that we may be coming into in 2023, at this moment, we do see most companies, especially in the IG investment grade space, as being fairly well positioned to handle that. So, again, we like those attractive yields. And then we also see opportunity in mortgage-backed securities right now. So that's one of our more interesting tactical plays too. So something like MBB, the iShares MBS ETF. But again, I think a lot of opportunities within the fixed income space, a lot of opportunities that don't require you to stretch for yield. So you're not taking on a lot of duration. You don't need to take on a lot of credit risk, but really offering investors income and yield that for many cases they haven't seen in decades.
Very interesting ideas. So switching gears a little bit, I also wanted to talk about thematic ETFs. And I saw that iShares released its 2023 thematic outlook as well recently. So 2020 was the year of thematic ETFs because many of these ETFs benefited from the pandemic. We all had to adapt to new ways of working, shopping, entertaining ourselves. So areas like cloud computing, video gaming, e-commerce, they did very, very well in 2020 as well as in 2021. They have been beaten down this year because these are growthy stocks, growthy areas. So they don't do well when rates are rising and when the economy is slowing down. And we have seen a lot of outflows out of thematic ETFs this year. So do you expect thematic ETFs to do well in the next year? And are there certain areas or certain themes that you like for 2023?
Yeah, it's a great question. And to be frank, it's one that we've debated a lot internally as well. And as kind of we talk about internal strategy and we talk about what's going to be in demand and how we can meet those investor needs with products that we launch. I think one really important thing to call out too is just that thematic does not necessarily just mean growth equities, right? I think that that is a common misconception in the marketplace and one that we're doing our best to point out that there's lots of different flavors of thematic investing. And I think that, our expectations for dispersion of returns to be quite high next year means that there's opportunity to get more selective in some of the opportunities that investors see. So one that we've already talked about a bit is infrastructure. We think of that as a thematic play and as a thematic investment. So, I think that that's one that we've already spoken about that tends to be a good inflation hedge that can benefit from that $1.5 trillion worth of government spending that's going to be directed towards infrastructure and clean energy in the U.S. So, I think that thinking a little bit more broadly about what constitutes thematic investing is going to be really important in 2023, and infrastructure being sort of top of our list there for where we see opportunities. But there's other opportunities too. So I think maybe breaking down technology and not thinking about tech stocks as sort of a monolith, if you will, is also going to be a really interesting way to think about thematics next year. So, even in a market downturn and in a higher rate environment, we still think that there's going to be growth potential for things like cybersecurity and things like robotics that can, help on the automation front as well. So I think, again, the outlook for what we call mega trends and what the broader market, the more kind of generic term is just thematics, is getting a lot more granular for 2023 and thinking specifically outside of just that growth box too. So, I know we've listed some of the tickers that we have that are, that we see opportunities in, things like, the self-driving EV and tech, IDRV, iDrive, if you will. And again, IFRA, I think is being another one that we're really focused on, given the macro environment, given the political environment, and then really just given kind of investor demand that we've seen for that exposure as well.
Excellent. And I totally agree with you on the cybersecurity theme. I like cybersecurity ETFs. And in full disclosure, I do own your iHack ETF in the ETF investor portfolio that I manage. And we have seen that many companies have started cutting discretionary spending because economic uncertainty is rising. But cybersecurity is one area that they cannot afford to ignore. So they will have to continue spending on cybersecurity. And we are likely to see cybersecurity spending go up in the coming years. So that's all we have time for today. Christy, thank you so much for joining us and for sharing your insights.
Thanks so much for having me. It's been a great time.
So that was Christy Akolian from BlackRock. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.